Good evening, everybody. Welcome. Oh, we did not kill any shark, nor any managers, nor any consultant. No. But this film was meant to be exactly the summary of the topic we are going to tackle nowadays. That's to say, calm waters that may nonetheless hide dangerous situations. So there might be a danger lurking under the calm waters. It could be low rates, it could be central banks, it could be billions worth of government bonds, as well as corporate bonds that are in negative territory. So how can we protect ourselves? Should shark attack us? Should the water become rough? How can we protect ourselves? Today, Adrian Bender, who is in charge together with Hervè, Hanoune, and Ludovic, Colin of the aggregate bond strategy, they will tell us how to tackle these situations nowadays. Thank you.
Thank you. Good afternoon, everybody. My name's Adrian. May we thank you for coming this afternoon. We're delighted to see you, and also a huge thanks to our wonderful Italian team for organizing this and for inviting us. And I don't know if you recognize your sales guys in the film there. I thought they were brilliant. Well done, Sonia. I saw you. September is always a very interesting time to look back at the trajectory we've had since the start of the year, probably where we are now, and a little idea of maybe where we're going. And in that respect, we've got hopefully a very interesting agenda for you this afternoon within the context of negative yields and some risks. And the idea with my beloved colleagues from London is to talk about a few subjects. The first subject will have a bit of a macro overview. What's the pulse of the world at the moment? We'll then go into a bit more detail of the fixed income market, what's going on in fixed income, very important asset class for Italian investors. And we'll do that with Ludovic. Then we'll look at a bit more detail the fund, Global Aggregate. We'll do that with Hervè. And then finish off with current positioning, and we can go into Q&A and have a discussion. I'm actually very privileged. I'm here today. I was in Argentina last week and Uruguay. Before that, I was in Holland. I have the privilege and the honor to meet very many investors from lots of different jurisdictions. And probably apart from Miami is very different. Miami is route one, risk on. They just buy risk. They don't care. They just buy risk. Everywhere else, it's a bit more nuanced. And if we take stock of where we are now, we see we've had a very strong rally since the start of the year. Rates have done well, credit has done well, emerging's done well, equities have done well, and most investors, we tend to see that valuations are quite expensive, positioning is quite heavy, liquidity is not always that easy. So that was the reason why we wanted to talk about Global Aggregate this afternoon, because it's a fund which is extremely diversified, extremely liquid, very lowly correlated with all asset classes, which has a very strong track record, and I'll come back to that in a minute. And it's a solution, a fixed income solution, which we think is very interesting for investors now, because also the second point is we're going to talk about barbell. Barbell. What is barbell? A barbell, you go to the gymnasium, you kind of lifting. Barbell, you have weights on this side, you have weights on this side. Now, when I travel all these various countries, the investors I see are very good at the risk. They're very good at buying risk, buying equities and buying credit and emerging. The other side is often a bit harder. What do I hedge my portfolio with? What is the cheapest, most efficient hedge I can find to hedge my portfolio so I have a solution rather than just a sum of risks? And that's why we'd like to talk about Global Aggregate today, because it's a low risk, low volatility, low drawdown, robust solution which could be interesting for those investors who are maybe looking to take some directional risk off the table. So just a couple of words about my colleagues, so Hervè and Ludo. So we were working together for very many years. Well, actually with Ludo we worked together in Paris. And then in London we worked together at Amundi for very many years, and with Hervè we developed a strong global aggregate strategy at Amundi. And Hervè moved 5 years ago. Hervè joined 4 years ago. I joined 3 years ago. And when I left, the strategy at Amundi was 8 or 9 billion. So it's a very big strategy. Most of you probably know it. So the gentleman who launched the strategy at Amundi is the guy at the back over there. So congratulations to Hervè. He's done a great job, and we're delighted to be back together in Zurich. So on that, I'll hand over to my friend Ludo, who's going to talk a little bit about macro. There you go, mate.
Grazie mille. Buonasera a tutti. Unfortunately, I need to switch to English, so I will sound more like Donald Trump. But the first thing I want to speak about is the world outlook and the potential risks that we have identified for the few months that are coming. Let me start with the central scenario, the one that you've read everywhere. The central scenario, the consensus scenario, is what we call a growth L shape. The growth have slowed down to a neutral level called the potential growth, and we should remain at that boring neutral level for an extended period of time. Here on this chart, you see two lines. The yellow line is the manufacturing, the industrial part of the global economy. It has slowed down a lot, but it's not stabilized, slightly negative, but it's not a catastrophe. The other line, the blue line, is the consumer, the service part of the economy. That has slowed down a little bit, but it's still very positive. And so the first conclusion is the manufacturing world is not going very well. The service and consumer world is doing okay. And that is the direct consequence here. Here you see the growth in all different parts of the world. Pink is the average in history. The yellow line is the emerging world. The emerging world is growing well and actually is doing better in the last few months. The blue line is the developed world. It's us. We're not doing so well. It's not a catastrophe. And it's not going better. We're there, stuck at a boring bottom, but there's no recession yet. What the consensus and most of the people think, and the central scenario is, that the central banks will keep that state the longest possible. They will try to extend the current economic cycle to avoid any catastrophe. If that happens, that's fine. Don't worry about anything. The problem is we have identified several disruptive, bad scenarios. The first scenario is we could be heading for a sooner than expected recession. And the root of the recession could be this chart. On this slide, you see the corporate margins are falling, and the leverage or the amount of debt these corporates have is going higher. The gray area are the previous recession. Every time we are in a shape where profits are falling and debt is going higher, usually it's the first sign that a recession is incoming. The other worrying signs is unemployment. The world as a whole, especially the US and Germany and other big economies, have seen the unemployment rate falling, which means that people have more and more jobs. That chart shows that the forecast of employment, or the appetite from the corporates to hire more people, is falling. Basically, it should be harder and harder to find a job in the months to come. It is usually the first signs that a recession is coming. We don't know if it comes, but there are serious signs that it might come. The problem is, you need to ask the financial markets what they think. Do you think there will be a recession, or you don't think there will be a recession? Here, it's a mathematical model that helps us detect each bucket, each assets. What are the chances of a recession for them? You can see there that, for example, the S&P 500, at the beginning of the year, after the horrendous December, was pricing nearly 50% chance of the recession coming in the next 12 months. From our metrics, today, there's nothing priced. The equity markets price nearly 0 chance of recession coming. And then you can see, for example, in credit world, the US high-yield credit here. Same, we started the year with roughly a 30% chance of a recession coming. Nearly nothing today. The price of assets and the assets geometry shows that the market is not prepared for a recession, except one, the fixed income market. This is the US Treasury 5-year. The US Treasury is the biggest fixed income market. We started the year with a 30% chance recession coming in the next 12 months. We are now pricing nearly 70% chance. One of these markets is wrong. There's two solutions to approach the problem. You choose a camp, and you might be wrong, you might be right. We just decide, I don't mind. One is already pricing a recession, one is not pricing a recession, they will meet in the middle. One of them is wrong. That's the approach we have. The second main disruptive scenario is inflation. We have grown up to believe that inflation will never come back. It's not a problem. Why should we worry about it? The central banks are telling us there's no problem with inflation. Well, actually, if you look at the signs and the chart here, this is the orange line here and the blue line there. This is the classical way to look at inflations. And indeed, they're falling. But people are telling you it's very funny. There's less and less inflation, they say, and the prices are higher and higher. Why? Because if you remove from these components there all the one-off, what we call one-off is internet company in the US dump their price by 50%. It's a one-off. It's done. But you remove all these one-off, the real life, the real inflation is actually running closer to 2.7%. It's just you decide which way the central banks want to measure inflation. There is actually inflation in the system. But let's look at this. This is the global wages in the Eurozone. The wages in the Eurozone is where there's no inflation. European Central Bank is saying there's no inflation. Wages are growing to nearly 3%. We are nearly at 4% in Germany. In France, it's the highest wage growth we have seen in a decade. And so you need to believe very strongly that higher wages will not create inflation on the long run. This is what the fixed income market is telling you. Don't worry about wage growth. There will be no inflation. That's a potential catastrophe if that happens. The third scenario, it's The fixed income market is you have a level of interest rates, which you can borrow money from, and you've got the quantity of the money available to borrow. And that line here is actually the total quantity of money available to borrow to the financial sector. It's falling, and it is falling very, very fast. Why should we worry about it? If you are a corporate, a company, and you need to roll your balance sheet, borrow money, you go to see your banker on the 1st of January, he gives you money for 3 months. You're going on the 1st of April, he gives you money for 3 months. You go on the 1st of September with a nice smile on your face and you say, sorry, it's not you, I've got no more money to lend. That's got nothing to do with what the Federal Reserve's yield are doing. It's just there's no cash in the system. I could explain to you why there's no cash in the system. There's no cash in the system because people are buying assets and they're removing that US dollar from the system. Why is it a problem? Because if you cannot roll down your balance sheet, you cannot hire new people, you cannot buy new computers, you can't invest. It's bad for growth. It is a risk. And then the fourth main question mark and risk that people ignore is the level of the US dollar. You are all European investors, you think in euro, why should you care about US dollar? 75% of the economy, including non-US, borrow in US dollar. And their basic currency is something else. If the level of US dollar explodes higher, the level of debt is going higher. The cost of reimbursing that debt is going higher. The problem we have is that on that chart, you've got what we call the US dollar smile, big smile. When the US dollar on the right-hand side, when the USA, boom, the economy is magnificent. They are the leaders, they are the engine of the global growth. US dollar is strong. It's not a big problem. They're just transferring part of their productivity and competitiveness from the economy to the rest of the world. It's good. When the US recovery is slow, but the rest of the world is still okay. US dollar is low, weak. That's okay, don't worry about it. The problem is here. When you have a recession, and we think it's actually on that line here, if it happens, US dollar becomes strong. And US dollar becoming strong means the rest of the world cannot borrow money, or if it borrows money, it's more and more and more expensive. ECB can, the European Central Bank can cut rates as much as they want. If we're in that situation, that's it, it's game over. So that's the macro. But on top of it, Matteo, what's that?
For French.
Ah, okay.
French.
Okay. On top of it, you could be the best economist in the world. You could have the best forecast of inflation, growth, margins, dividends in the world. It will not have helped you in 2018 and 2019 to avoid Mr. Trump triggering trade war, to avoid the Brexit being poisonous for some part of the assets. And it would not have helped you with the recent news we had at the weekends of bombing in Saudi Arabia and the price of energy going up by roughly 10%. The point here is macro outlook is important. You need to understand what's good in the world, what's bad in the world. You need to understand what are the risks, but you need also to understand that you could be surprised by anything just from a tweet. And it could have huge consequences to your performance and the performance of your portfolio.
Before we make the transition to fixed income, I do actually have a question, Ludo. You've talked about a central scenario, a somewhat benign central scenario, L-shaped growth. You've mentioned potentially 4 disruptive themes. And a couple of questions on my side. How much confidence would you place in your central scenario? And the second question is, the story's been reasonably US-centric. China seems to be a little bit out of scope at the moment. Does that mean that things are getting better in China? Or is that something you're still very much preoccupied about?
Okay, so the first question, probability that the consensus benign central scenario is what we're going to get in the next 12 months, 50%, no more.
It's quite bearish.
So it is 50%. It's not bearish, it's not bullish. It means there's one chance out of two that next year will be boring and nothing will happen. It will be easy to manage money. And there's a chance, 50% chance that it will not. That's my answer. Okay. Second question, China. Very important. China is not doing very well for several reasons. The main one being Mr. Trump. There are other ones. They are trying to do something about it. They are injecting liquidity into the economy. In the past, it has been enough. The main difference this time is that the part of the economy they are trying to revive is the part of the economy that will not help the rest of the world. This time, China is helping China. They're not helping Germany sending tools to China. They're not helping USA to export farming goods to China. They're helping themselves. That's the first thing. So it's not positive. The second thing is that if they are failing, and whatever they do, whatever credit they inject, they fail to reform the economy, the leverage of the Chinese economy is huge. If we have a recession elsewhere in the world, they will collapse. And that would probably be one of the biggest crises we've seen in the last 10 years, at least. I'm not saying it's going to happen. It's not a big probability. It's actually quite small. They're quite smart. They've got reserves. They've got a strong economy. They've got a big population. But if it happens, it's bad.
Next one. Let's move on to fixed income.
Okay. So in that part, I'm trying to explain to you what is the challenges from now on for people who are investing in fixed income. When I speak about fixed income in this part, I mostly speak about government bonds, borrowing interest rates, US Treasuries, European Bund, and Japanese JGBs, not other parts of the fixed income. That cartoon is quite funny. Switzerland and Japan, they're already down there. Europe is coming. The big question is, what are we going to do with the US? And is why that cartoon is funny, but it's actually extremely bad news for all of us. Very bad news. So that's the picture. Switzerland, 10-year yield, already at -1%. Germany, 10-year yield, roughly minus 50 basis points, 0.5%. And all the others are coming. You've got lots of room in the USA. We're at like 1.8%. It could come much lower. If we accelerate to the downside in terms of yield, these are already there. These will be the one moving much faster. That's the fact. How big of a problem? This looks like Bitcoin. Bitcoin. It looks a bubble. It looks something not normal. What is it? It is the total size in US dollar of bonds that have a negative yield. The total size is 15 trillion US dollar in the world now return a negative yield. It means a third of the debt has a negative yield today in the world. So now, for you and us, we allocate investment. Why should we care? This is the reason. Balanced portfolios. Let's take the average rule. 60% of equities, stocks, 40% of fixed income. All right? You learn that at school. Usually when the equity part collapses, the 40% part of fixed income saves you. Job done. Let's go to the pub. Not anymore. The problem is that, for example, That's the 10-year yield in the US. 1.77 is the current level. Here, that blue bar. The big question is, let's say I've got a balanced portfolio, 60% equities, 40% US Treasuries. And the equities, the S&P, dropped by 10%. Where should be the yield going to be flat and have a performance at 0? The yield of US Treasury should go to 0. That's possible. That's possible. Not a big problem. Let's look at Europe now. We are currently at minus 0.5%. Let's say 60% in equities, 40% in bond. Where should it go to protect me? The bond yield should go to minus 2%. Minus 2%. The third biggest economy in the world, government bonds, minus 2%. Impossible. It will not happen. Which means the rule will not work. Which means that the fixed income asset that you thought would help you if things get bad will not help you at all. That's the first problem. Now, some of you might think, I don't care, because as long as the yield continues to go lower year in, year out, I will make money. Like this year, I don't care if the yield is negative. My capital gains go higher. You're right, that worked this year. Let's look at this. If I'm a European investor in euro and I buy a US Treasury 2-year bond, which currently yield at 1.67, and we imagine that, like this year, the yield of that bond is going to collapse by 50 basis points and go to 1.17 here. All right, what we had this year. How much will be my return? Negative, minus 0.3. Because the negative yield hurts you so much that even if the capital gain goes higher, you lose money. If you buy US Treasuries 2-year, this now, in 12 months, even if the yield's gone down 50 basis points, you will have lost money. Now, even worse, this is the yield, or the carry, of the global aggregate yield in euro here. That's the biggest benchmark in the fixed income world. The yield has gone from a bit more than 0.5% in October last year to minus 20 basis points this year. So you're making less and less and less money investing in that benchmark. That's the black line is the volatility of the fixed income market. How volatile are the bonds? They are more and more volatile. It's rare that they're as volatile as that. So basically, fixed income bonds, government bonds, give you less and less and less money. They actually cost you more and more and more money. And the volatility of your investment is bigger and bigger and bigger. It is a very worrying investment profile. Now, just to give you a feeling, this is in black the same benchmark, the Bond Global Aggregate in euro. So far this year it's roughly up 6.5%. So if you invested in that strategy, you think you're world champion. Well done. The main reason was the bond yield went from 80 basis points to minus 60 basis points when that chart was done. That's the only reason. Yield collapsed. Okay, how much should the bond yield go for you making another 7% next year? Minus 1.4%. The only way to replicate this year's performance in the next 12 months is for the bond yield to go to minus 1.4%. We can think about a scenario where you want to be invested because it will go to minus 1.4%, but it's not a very rosy scenario. It means fear, collapse somewhere in the system. It's not good. I want to give you a clear example what it is that I'm talking about when I'm speaking about volatility. This is the Austria government bonds expiring in 100 years. Yeah, they issued 2 years ago a bond for 100 years, and it pays you 2.5% per annum. That's the coupon. That's the price action of that bond. July and August this year, in the summer, that bond price, that investment, went up by 41%. It's a bond. It's not an equity from Venezuela. It's a bond. And then September, nothing happened in September. Did you read news about Austria or about the world? Nothing happened. It went back down by 18%. This is not fit. This is not fit for long-term fixed income investors. There is a serious problem in the fixed income market right now, and people forget to pay attention. This is what I was talking about, the benchmark again. It's got a negative real yield. I spoke about -10, -20 basis points here. Most of it, the black part, is government bonds. 80% of its risk, there in pink, 80% of the risk is just the level of yield. You can see it here. That's the benchmark in blue. That's the US yield this time. Same stuff. So if you're a traditional fixed income portfolio manager, and you manage a portfolio like that, the only one way to make money is to be right on the level of yield. So you come, 1st of January, you think about, and then you say, I think the yield goes up, or I think the yield goes down. And that's the only way you can make money. If you are wrong on one thing, boom, no performance. That's what you do when you invest in that sort of strategy. You bet that the guy is right 100% of the time, every year, on where the yields are going. In January, you would have asked someone, we're going to see -60 basis points in Bund this year. Nobody would have said anything about it.
I'm looking forward to seeing Venezuelan equities going up 40%.
Well, about 250%. So now I would like to introduce Hervè Hanoune, who runs fixed income. He also runs the Vontobel Global Aggregate, and invented the concept. And he will explain to you how we managed to go around all these issues I've just expressed. Thank you very much.
Very good.
So good afternoon, and thank you very much, all of you, to be here. So I'm scared, and I think you've been scared by Ludovic and by the shark as well. So let's see what is our definition of fixed income, because obviously what we observe is that duration is dangerous. That's what I understood from Ludovic. But when you look at fixed income is much more than that, because what we saw now, we talk about US rates, we spoke about Euro rates, could be UK rates and Japanese rates. But fixed income is also all the credit parts, globally, Europe, US, high yield, emerging corporates, all the currencies, because currencies are also part of fixed income. They are also linked to central banks. So you have subordinated debt. You can also add up, for instance, mortgages. So you have a very, very large universe. But what is important is the value change in all that universe. What we just described is that the value, and what I understood, is value is clearly not here. So what you need is a tool, is a fund, which allow you to go to seek that value. And this solution is the fund Global Aggregate, Vontobel Fund's Global Aggregate. So what it is exactly? The fund Global Aggregate is a flexible strategy which seeks value across this whole universe I showed earlier, in the whole fixed income universe, with two clear objectives. The first one is obviously to beat the fixed income market, but the second objective, which is also very important, and which is very key to you, and particularly at this level of yield, is to have a positive performance. Because I can tell you, I've done a very good performance, but if the fixed income market is going down 20%, you just don't care. You want also a positive performance. So how we do that? We do that by analyzing the market through global macro techniques, which mean like a more top-down approach to analyze the market through different prisms. For instance, the macro analysis, valuation, so you can analyze an asset through valuation. You can analyze an asset through the technical and also through the flows. For instance, when you have very accommodative central bank, the flow are very important. This amount of liquidity on the market really dictates the valuation and your expected return. So what do you get from that? You get something quite exceptional. You have performance, and you have a decorrelated performance throughout the cycle. What do I mean by throughout the cycle? I mean that in good time and bad time. And let's illustrate that. So first of all, what we observe here, it's the Morningstar category Global Flexible Bonds, Euro Hedge. And here you see all the funds, so all the quartile, from the top quartile to the bottom quartile. The little square is the fund, and the little triangle, the blue triangle, is the benchmark. So what you observe here is that since inception, so over the last 5 years, more or less, we deliver to, first of all, beat the fixed income market with an analyzed performance of more than 2%. But what is very important as well, this is the only fund which had every single year a positive performance. You can see that the black spot is always above 0. So we've reached on this fund our 2 objectives. But what is even more important is how we reach that objectives. We reach that objective by being totally decorrelated from fixed income markets. So you could say, okay, it's normal you have a very good performance because obviously duration did very well. Yield went down, you are a fixed income fund, you perform very well. But what you can observe here is like this performance came from almost 0 or even negative correlation in some case with corporate bonds, negative correlation with risk like Euro stocks, and even very low correlation with the fixed income market. So how do we do that? And what are the key aspects of our strategy? So we are diversified. I will show you across different asset classes, but much more than that, strategies and time horizon. We are flexible. It's very important, obviously, to be flexible, to adapt to market conditions, to be able to seek that value wherever it exists. Agnostic, which is quite important. What do we mean by agnostic? Is that we do not have any bias towards one asset class. That means that if we don't like an asset class, we do not invest in it. We only go where we see value. And last but not least, convexity. What do we mean by convexity? We want an asymmetric profile on the portfolio, which means that when we lose much less than when we gain. So you have a portfolio which is very convex, and we look for convex strategy. So let's develop a little bit that what I've just said about these 4 points. So the first point was diversified. So you will hear a lot about diversification, but here I believe we have a quite unique way to look at diversification. We don't not only talk about diversification by asset class. We talk about diversification by investment style and different type of strategy. So you have your directional position. Your directional position will be, for instance, do I like credit? Do I like subordinated debt? Do I like duration? Do I like US dollar? All this type of market return profile, which are sometimes offers a lot of value. But what is important is to combine with the second engine of performance, which is the relative value. Because relative value offers value, but decorrelated position compared to directional position. So just to give you an example, here you can say, okay, I have no view on duration, but I have a strong view on the duration between UK and Europe. Or I have a very strong view of Australian dollar against New Zealand dollar. Or emerging market corporates against US high yield. So it's a type of diversifying factors. And the third engine is a diversification by time horizon. Because here, I would say you have more long-term views, so strategic, global, macro, top-down views. But in this world of uncertainty, of very low yield, as we show on the graph of Ludovic, higher volatility, when we have a president in the US like Trump, which sends tweets, which send the market everywhere, being able to take advantage of this volatility and this short-term volatility is very, very important. So it allows us to be able to benefit from that, which is very important. And last but not least is a dynamic risk overlay. As I said, one of the key objectives of the fund is to deliver positive performance. And the way we do that is by analyzing the market and finding the cheapest hedge on the cheapest assets. But it's also important to be able to identify the cheapest hedge because it will give you a lot of convexity, as we will see a little bit later in the position. So the second level of diversification, obviously, is by assets. So the fund is able to invest in government bonds, investment grade, high yield, with a maximum of 25% on corporate high yield, currencies, inflation-linked, convertibles, and emerging markets. We are very flexible on duration. As I said, we consider duration as a source of performance, so we are not obliged to have duration. We can go from 0 to 8 on the duration with an average rating of investment grade. And what is very important is we have control volatility of less than 5% on this fund. The second point, which was also very important, is the flexibility and the liquidity of the portfolio. So first of all, liquidity is essential in our approach. We are able to cut, I would say, 90% of our position within 1 day. So it's a very liquid strategy. But also, what you see is the flexibility. What do we mean by flexibility? Market is not homogeneous, which means that sometimes you have a lot of opportunities, sometimes you have less opportunities on the market. So we are able to adapt the portfolio to the different opportunities, and sometimes we have a portfolio which is with a very low risk. Sometimes we see more opportunities, so we will have a higher risk. And also, the opportunities, as I said, do not come from the same place. Sometimes it will be more currency, sometimes it will be more credit, sometimes more emerging, some more rates. So you have an evolving risk and risk allocation inside your portfolio, which is very important. The third point was agnostic. And when we say agnostic, as I said, is like this, what you see here is a correlation with the bond market, represented here by the Global Aggregate benchmark. So sometimes we are positively correlated, but as you can see, some other time we are not correlated at all. We have no bias toward duration and toward the different positions. So, which allows us to perform in any kind of market condition. And that's also very key in our approach. We are not market dependent. That means that we can perform in any type of market condition because we can evolve and change the portfolio and adapt the portfolio to this market condition. And the last point was about convexity. So what you see here is what we want to achieve is to have position, and particularly on the risk part of the portfolio, which means like the part which protects the portfolio in terms of volatile market, is to have a lot of convex position, where you have a very well-controlled loss, so you know exactly how much you're going to lose, but at the same time, on the OZN, which is very correlated to risk, which is also very correlated, for instance, to equities. If equities goes down, you can be sure that OZN will go down. And here, it will totally protect your portfolio. We'll show you in the later how, in the past, it has protected massively the portfolio. And when you have risk-off period, the fund has been performing also very well. But to get that, you need to have also the right team. Because we do invest in all, as I said, the whole spectrum of the fixed income. As you may know or not, actually, Vontobel has one of the strongest teams in fixed income. We have among the best performing funds in each asset class, in emerging markets, in credit, and we are supported by a team. And what is very important is that we are all seated together. That means that we have a very strong cross-pollination. That means that we communicate on a real-time basis to see these opportunities, to seek this value. And we are supported by Ludovic in emerging market and all his team on corporates, on local rates, with all the global team, and on credit by Monder, Betayeb, and his team. So you need also the right team to be able to manage this type of strategy. So just now to speak about performance, and your obvious question is, have we delivered what you are expecting? So as you can see, the performance over this time frame from July 16, so the fund has strongly outperformed the bond market, despite the fact, for instance, here that we were negative on duration. So the benchmark has performed very well linked to duration. So you can say, okay, you were long duration here. But actually, it was not the case at all. We were, all the performance here came from different other factors, which are very different from the factors here, like currencies, like credit, like emerging markets, like relative value. So the multiple engine we have in the portfolio allowed us to perform very well over the different periods. And what you observe here, which is very important, is we focused here on a time where you remember very well was December 2018. What happened in 2018 is, I would say, the last period of big move on risky assets, like S&P, like credit, like corporates, and so on. You remember very well. So at that time, we were very long corporates, we were long also subordinated debt because we believe in the value of this type of assets, and they went down quite massively. But what you observe here is that the portfolio, thanks to this dynamic risk overlay and this convexity we have in the portfolio, had a very strong positive performance in December 18, and as I said earlier, was one of the only funds to be positive in 2018, despite the fact that we had negative performance on credit, on some emerging. That means that we will not be right on all the positions. We will be actually wrong on many positions. But we will be right also on other many positions. But what is very important is how we built all these positions. The portfolio construction, which is very solid, because the portfolio construction is like a Lego. If we take a position on a standalone basis, it will not work. You need to take into account all these positions and their correlation and how they work together. And then you create a stable performance. And here you see that you have different market dislocation and that you have different entry point. And altogether, when you have market dislocation, you always rebound on this portfolio. So now, we will show you how it works. So what are the positions we have right now in the portfolio, and how, this is a bit theoretical, what I said. Let's see exactly how we implement that inside the portfolio. So I leave the floor to Ludovic to explain you that.
Thank you. It's me again. This time I won't scare you too much. So in this part, I'm going to show you briefly how we invested right now and how it works in details in a few examples. First of all, it's Hervè at the gym, so that's well done. The problem we all have is that we see there is opportunity to invest in good assets that we think, it looks like it's a good asset. But we also, and I've shown you, there's lots of reason to be extremely worried with your investment. How do you go and get the nice stuff without being scared of the bad stuff? And that is the barbell approach that Adrian spoke about in the introduction. That's a barbell. On one side, we invest in what we like, what we think makes sense, what we think will return a performance. And we do what we call the best value yield available. On the other side, we try to find insurance premium, insurance to protect your performance for a small cost. And there are always ways to protect your performance. And by these two combined together, you end up with a stable long-term performance that usually is not dependent on any shocks or any market moves to perform. So I go back to the four big ways we invest. Directional position in blue, relative value position in yellow, tactical in pink, and dynamic risk overlay. First of all, what do you like in terms of directional position, where the market is going? We hate duration, basically. Interest rates, we don't like them, they're too low, and they're too volatile. I explained that. So it's not a good way to make money. But there's a good way to make money. We love European subs, subordinated debts from banks. We like some peripheral country. Portugal is a good one. Portugal is good because Portugal gives you a yield, it doesn't move. So you've got something with a carry and a low volatility. The opposite of the bad part, where you have a negative carry and a positive volatility. In relative value, in the duration world, interest rates, even if we don't like them, we think that there's a problem. US Treasuries yield 1.8%. Bund yield minus 0.5%. I know it's a big world, but it's not possible to have such a difference. One is wrong. Either US Treasuries go to zero, like everyone, either US Bund goes back to 1%. They can't stay there. So what we do, we take the 2.5% from US Treasuries and we buy them, and we sell the Bund. Tactical, they're all here. We are hedging the portfolio from shocks. What worked lately is we bought protection on yield. You know, the yield went from 1.5 in the US to 1.8 now. We hedged the portfolio from that, and we created performance. And dynamic risk overlay, we don't like Eastern Asian currencies, so we hedge the portfolio with that. But let's go in details. Directional position. Why do we like subordinated debt? Example, this is the subordinated hybrid credit paper from Barclays Bank. Perpetual, 7.25% coupon. And you can see the chart of the price of the bond is volatile, and you're just like, I don't know if it's a good investment. Let's look at last year. If you bought that bond 1st of January 2018, on the end of 2018, you lost 4.13% in terms of capital gain. You made a loss. But don't forget, it paid you a coupon at 7.5%. Yeah. So net, you didn't lose money, you made 3.12%. In a year where everything went down, there was a paper that gave you money. This year so far, same logic, capital gain plus coupon, roughly that paper has made 10% for its investor. It's a fixed income bond. It's from a bank. It's Barclays. It will not collapse. It's well managed. The cash flow are good. There are still opportunities like that if you look for them and if you know what you're doing. That's the good directional stuff. And it's an example of the many, many lines we have in a portfolio that look exactly like that. Relative value. It's the race to the bottom. Why do we want to be long US Treasuries and underweight Bund? There's two things. Yield to the bottom, everything goes to zero. Bund is already at zero. US Treasury goes to zero, you make money. Or the opposite. There's inflation coming back, growth is coming back, the yields are going higher. The market that is in big trouble if that happens is European market, because as soon as you see inflation and growth coming back, you're going to get rid of your Bund, that yield at minus 65 basis points, and you're going to buy something else that will make money thanks to growth and pro-cyclical environment. That's relative value. It does not increase the sensitivity of the portfolio to interest rates, one versus the other, but we have no view on the yield globally with that. Tactical. What are all these insurance premium that we put in our portfolio? What are they, and why do we buy them? Here is the example of the Korean won, the currency of South Korea. That country is extremely sensitive to global trade. They export a lot. They're also extremely sensitive to the price of IT and investment in IT. Both went very wrong in the last 18 months. Trade war plus the price of technology collapsed. The Korean won collapsed 15%, roughly, in the last 18 months. This is the black curve here, down, down, down. The cost of insurance in blue hasn't moved. It's still very low. This is totally crazy. Imagine you live in a village. All the houses are flooded by the river. Every day, one year. You pick up the phone, you call your insurer, and you say, I would like to insure my house against flood. Yes, of course you can. And it's cheaper than last year. It's crazy. This is what you can catch when you do your homework on the best way to hedge your portfolio. What does it mean to have this insurance premium in the portfolio? This is the Vontobel Global Aggregate of funds. That's the performance, that's the NAV. Here, this is the last week of July. Last week of July, Mr. Trump decided that he had enough with negotiation with the Chinese, that he would stop negotiation and tax at the 1st of October $250 billion worth of new imports. Bad news. S&P went down 7%. A lot of things happened. The Korean won collapsed as well. So the price of our insurance premium, we call the insurer and say, hey, you owe me money. My house just got flooded. And we perform. Bam. Did we know Trump would be silly? No. Would the performance gone that if it had not happened? No, it would have continued. But we were hedged, and so we performed out of surprise and out of negative surprise. Now, dynamic risk overlay. How do we hedge the portfolio versus a massive credit crisis? What if the credit market collapsed? What do we do? Well, I go back to that slide. This is the different bucket of markets and what is the percentage of a recession priced, or they think, in the next 12 months. US high yield think there is no risk of recession, zero, bam. So what is the market that will collapse the most if we have a recession? That won't be that one is ready, US Treasuries, it will be that one. So what we do, when we are a bit worried about the credit market, We buy US high-yield CDS, credit default swap. If the credit market collapses, that line makes money. In barbell times, what does it look? One side of the barbell, what we love. I spoke about Portugal, I spoke about subs, I spoke about emerging market that we love, the sovereigns and corporate, and how we hedge our portfolio. On the other side, short Asian currency, that's the thing that made money in August. CDS protection, the credit one. We are long yen. Yes, we are long yen. We love Japan? Not necessarily. Is it cheap? No, it's fairly priced, Japanese yen. But Japanese yen explodes higher every time the world sneezes. So we put yen in the portfolio, because if the world sneezes, we will make money. And that's it. This is what we have right now.
I'll just say a couple of words of compliment. We've been quick. We've been quick. So just a couple of things to kind of conclude on. On the left-hand side, what you've seen is over this cycle of 5 years, never had a negative year. But above all, we've had decorrelated returns, like 2015, if you remember, commodity crisis, commodity prices collapse, the renminbi devalues, people are worried about a Chinese hard landing. Asset prices collapse, the fund is up 5%. 2018, as we saw again, difficult market conditions across the board, the fund again delivers a positive return. So not only is it delivering this constant positive return, it's delivering performance when you need it most, when everything else is hurting. And how do we do it? I won't go through it again. It's this barbell, best value yield, best value hedges, by being agnostic, convex, flexible and liquid. So on behalf of the guys, thank you so much, and also our friends here in Italy, thank you so much. We're going to hang around. I think if anybody has any questions, please feel free to either ask, or I think also you may have received a piece of paper for those people who would... No, we're going to get questions, sorry, directly from the gelato. Prego. Don't be shy, there's lots going on, I'm sure. I have a question for Ludo anyway, so if you don't, I do. I'm just not going to make it easier for you, so please carry on. But coming back to fixed income markets, when you were talking about treasuries, specifically you were talking about potential bubble, and that section was clearly about sovereign markets, but can we still use the word credit and bubble in the same phrase, or do you think that credit is actually somewhat protected through a higher spread?
So I've shown it in my presentation. If you've got a credit paper that has a high yield, 7%, 8%, you are very protected against a drawdown in credit. If you have credit paper that has a small spread, not a big yield, protection is lower. The other thing is you need to analyze how much money you've made in your credit investment this year. So you look at a credit fund and you say, oh, it's done 8% this year, fantastic. But you need to analyze that performance comes from the duration itself, it's just because the yield came down, all the bonds went up, or it comes because he's chosen the right buckets of risk and the spread of what he has was compressing, or it's the right quality. And I think a majority of investment in credit have been in credit because they had no choice.
Crowding
Need a positive
out.
yield. Sorry?
Crowding out.
Crowded. And now it starts to look crowded. And the spreads are not moving anymore in part of the investment grade in Europe. It's there, and it hasn't moved all year. So it moved because of duration. And people forget that biggest risk of credit, that part of credit, is the yield of the bond and treasury, not the credit world itself.
Just to add up on that, as I said earlier, we are in the flows are very important, and a lot of people need return. When you are a pension fund and you need to pay you need to get return for all the retirement. So at the end, you need to find the yield somewhere. And where you find the yield today is in credit. So it has performed very well. As Ludovic said, now it starts to be quite expensive to fair value. Do we see a crash on credit, or in terms of fundamentals we are worried? No, because obviously what you observe for you observe also that for corporate. They can borrow, they can refinance, they can lengthen their credit profile to very long maturity, so they buy short-term maturity and they extend the maturity of their debt. So you have a lot of good news for corporate. So that it's not an asset class at risk. And they offer a small pickup, but it becomes more volatile. It will with a lower yield. The next part of it, of this journey, is definitely emerging markets, because today emerging markets offer a very good yield. Emerging corporates offer a very good yield compared to developed market, with actually not a such higher risk profile. So we think that emerging market also linked to these flows. So fundamentals are okay, but also the flows will be massively directed. And as there are much smaller markets, obviously, when you have strong flows, and when you look at the assets worldwide which need to be invested, you will definitely have it will have a strong impact on valuation for emerging markets.
Lisa.
Well, good afternoon. I'd like to know whether you could share with us some details on the current portfolio makeup and also the 100 million question. What is the expected return in the next 12 months? Thank you.
Je peux la faire, hein?
So, for the expected return, I will answer very mathematically, actually. The volatility is around 4%. So, technically, we should expect, in normal condition, a kind of 3 to 5% return on this type of strategy. Of course, it's on a cycle. To say on a one-year time, it's always very hard. But usually, on the investment cycle, exactly what you saw actually, it's around 3 to 5%, depending on the market condition. Of course, for us, what I wanted to add up is in market where you have more volatility, where you have more opportunities, obviously, it allows us to, obviously, to perform much better. When you have very boring market, yeah, we have some carry on the portfolio because the yield of the portfolio is at 4%. So by doing nothing, if market do not move, we will be at 4%. So all conditions equal, we are at 4%. So if you have volatility, we can even have a better performance. But this is for more mathematical, how much you are rewarded for the volatility. And maybe for your first question was how do we build the portfolio? The position, or what are the, yeah. So just to describe, so what you can see here actually is the yield to maturity, modified duration, actually the last data, this one, number of position, and the average weighting of the portfolio. So for the construction of the portfolio, as I said, we allocate risk. Risk for us is really an input, which means that when you have a lot of position, a lot of asset classes, when you have different volatility, a lot of correlations between all these assets, obviously, when Ludovic described positions which hedge other positions, you work also with a new asset class, or two new asset classes actually, which are volatility and correlation. And they are asset class per se because correlation change over time and volatility change over time. And when volatility is very, very cheap, you can buy it and we can make a lot of money with that. So the way we process on just to describe a little bit the investment process. I hope I will not be too complex. We have a scoring. So we have an investment committee. We are 5. We have a scoring. We score the views. For instance, we can say European credit investment grade. We don't like it right now, so because we think it's too expensive. So we will go from -3 to +3. And we score all the positions, all the currencies, everything like that. After we optimized. What is an optimizer? An optimizer is a mathematical model will take into account all the correlations and all the volatility of the assets to define, based on your view, the optimal portfolio. So there you will say, okay, ideally, with the view you have, if you score, for instance, +3 on subordinated and 0 or -2 on the US dollar, it will tell you, okay, you should be short, theoretically taking into account everything, 12% of US dollar and maybe a long of 25% of, or 7% of European subordinated. And after you will allocate that position. So maybe you say, okay, maybe it's too much, or you have a bit less or a bit more, but it allows you to have a very stable risk allocation. And what is important is we know exactly how much each position consumes in terms of risk and what each position, how it decorrelates your portfolio. That means that if you adopt the volatility of each position, you will have high volatility, and thanks to that, you have a very low volatility and a stable performance with a controlled volatility. Does it answer the question?
In terms of positioning, currently, this is the portfolio as it stands. So we heavily invested in Europe, Italy, Portugal, France, a bit of Spain. We've got a very low allocation to the rest, and there's a big bars to emerging markets. The other part is the portfolio structures. The benchmark in blue has huge share of agencies and developed. We have nearly none. We go into financials. I explained to you why they were a good value. A few industrials, mainly in utilities that have a big pickup. We invest in some government and agencies in emerging market. There are papers that are extremely important for those countries, so the risk of default is very weak. We have a huge granularity of investment. We've got 137 different lines, which means we try to limitate the risk of one single country or one single corporate to go wrong. And the other thing is, at the moment, we've got 0 duration. We expect the yield in the very near future to go back up, so we don't want to participate anymore in the trend we've just seen. But the average rating of the portfolio remains investment grade, and it's a bit higher than that because of technical accounting. We're around 1- to BBB.
Do you want to say something on the FX? FX positions.
So here, what you see is, I will not go into each position, obviously, but what you can see here is the diversification we have, and within all the different currencies. So on the left, you can see where we are long the currencies, except for the euro, because obviously euro is our reference currency. And on the right, all the different short positions. So obviously, as we describe, China, the way to play a risk-off with a very convex profile, that's why we have this position in China, is because it allows us to have this very convex profile on the portfolio. We said we don't like Asian currency, and you can clearly see that from China, Singapore, Korea, Australia, Taiwan, and Canadian dollar. So maybe one word to finish, actually. So thank you very much. But what you do by investing in this fund is you buy a bond, without the duration and with a strong coupon and a strong expected return. And also the second thing, which is very important, is when you add this portfolio in your allocation, you increase your adjusted return because you lower the risk of your portfolio and the volatility of your portfolio because this fund is totally decorrelated with a strong performance.
Grazie.
Thank you. Thanks a lot. Thanks, Ludo. Thanks, Hervè. And thanks, Adrienne. We wanted to organize this event at this point in time because this year was really a special year. I mean, look at any asset class this year. I mean, all of them performed well. So in the summer, when the weather is fair, what do? You fix the roof of the house. You maintain your home to protect your house when the weather turns bad. When Ludo said the scenario has a 50% possibility of materializing, so one chance in two to materialize. So maybe next year we'll live a very boring year and we'll get bored too. But you know, you got to know sharks. If you get to know sharks, you may even have fun swimming along them. But first you have to get to know them well. So thank you very much for your presence here today.